Money managers are really starting to warm up to this market now. This is your indication of bearishness. Up here, everyone's excited, right? We get tax cuts and all this stuff, but look at this swoon that we saw. And just right now, it's still bearish, but this is actually the least bearish folks have been since February of 2022. These are your experts, by the way. I want to bring in my next guest because she began to warm up to this market too, not long ago. And since then, Erin Gibbs, you've seen some de-risking signs here, though. So. You warmed up just in time for things to get a little chilly here. Talk to us about, some of the things you've seen. This is a great table that you put together for us.
Yeah, well, like we just saw, there are a lot of ups and downs and little peaks and valleys in there. And so we've seen basically a bit of a pullback. It started July 18th, so we're sort of 4 weeks in.
So you had the tech stocks?
And so that's when we really saw the tech stock peak really starting to come down. That started pulling down growth.
The growth?
The very next week. And then that started pulling down the broad market,
right.
Really started spreading the first week of August. And then we see a shift in leadership. So that's the real change.
But the idea, though, is when defense is leading, that's not necessarily good for the overall market.
Right, because it means it's really more about fear. I just want those safety stocks. I'm not looking forward to growth. I'm concerned about the growth in the U.S. and the world leadership. So there's definitely some risk off here.
You talked, though, you kind of hinted, though, that this may just be a short-lived, normal kind of event after the kind of spike we've seen,
right.
Summer doldrums. So this is not necessarily something to get alarmed about yet.
Right. This is still, we're talking about just taking some risk off the table. And really, there were a lot of concerns on Wall Street about valuation being very expensive, stocks being very expensive, particularly those high growth stocks. So this looks like we're just taking some money off the table and maybe just becoming a little more rational about where growth is going to come from in the next 6 to 9 months.
So someone who was buying in the last 3 months is Warren Buffett. Now he's sitting on $150 billion, but he put $800 million to work in home builders.
Right.
And last time I remember you being in Toll Brothers.
Yep.
And Pulte.
And Pulte.
So are you still in those?
Yeah, and Pulte is still one of my favorites. I think it's.
Did Buffett call you before?
No, not yet.
Okay.
But I'm open to these calls. But look, I like Pulte and over some of the others like D.R. Horton and Lennar, just because of valuations. They're trading at about a 20% discount, so just a little cheaper and safer bets now.
And I used to be heavy in home builders. I always loved Toll because they had the higher end, more expensive homes. Is that still sort of a distinct advantage for them?
I think right now it's more about the valuation, just because we're in this risk-off environment and people want to play it safe. But yeah, single-family homes, if you're in single-family home area, that's definitely a benefit.
So we're in a defensive posture now. You've got some defensive ideas for us.
Right, and again, this is short-term, so we're just saying 1 to 2 months. But energy stocks, this is one of your energy ETFs. They trade very closely, so there's not a big differentiation between stocks. I think it's just easier to take an ETF. And then some healthcare providers, they've been doing really well.
This has been acting really great. By the way, folks, one of the reasons the Dow has done well lately, it's weighted by the price of the stock, and this is the highest priced stock on the Dow.
Yes, which is still very cheap. It's still like 7 times forward earnings, so it's not an expensive stock even within the Dow area. So United Healthcare and Alvina.
ELV is also in that space?
Yes, so another healthcare, managed healthcare. Again, cheap stocks, there's not a lot of room for it to go down. We've seen them break through some resistance, a lot of resistance that they were facing throughout the summer and spring. And there's at least another 15% before they hit like that next resistance level, both on valuation. So just a nice, safe space.
Good risk reward.
For the next month or two.
Inexpensive, using traditional market valuations and starting to act pretty good.
Exactly. So as long as we're a little scared,
I like that. You always got to be a little scared. Don't get too cocky out here, folks.